Welcome back to CFO Weekly, where we're talking with financial leaders about how to build efficiency in their teams, create time for strategy, and ultimately get results. With your host, Megan Weiss. Let's jump right in.
Today, my guest is Marvin Storm. Marvin has more than 30 years of experience in multi-location operations management, mergers, acquisitions, and developing and executing business exit strategies. After receiving his BS in accounting, he spent his early career with a Big Four accounting firm. Since then, he has launched and acquired businesses, worked with executive teams nationwide designing and implementing business growth and exit strategies, is a host for the Business Exit Stories podcast, and is currently writing a book on the art and science of executing successful business exit strategies. Marvin, thank you for joining me today.
Oh, it's great to be here. I am looking forward to chatting about this. I am kind of passionate about this topic, so should be an interesting chat.
Yeah, it's an honor to have you on the show. Today, we're going to be discussing exit strategies and why every business owner needs to have one. Marvin, you've not only learned lessons from your own exits, but as a podcast host yourself, you've interviewed plenty of M&A advisors, investment bankers, and business brokers to uncover the good, the bad, and the ugly when it comes to making deals. I'm excited that we get to learn from all you've learned along the way, so let's get started.
Okay, great.
First, tell us a bit about yourself and how you got to where you are today.
Well, I'm not probably a whole lot different than you are, actually. I took a right turn where you probably took a left because I got my degree in accounting and worked for one of the Big Four accounting firms back when I was a young whippersnapper and was playing a weekly pickup basketball game with a group of guys. And one of the later rivals to that group became good friends with. And we got to chatting, and I grew up in an entrepreneurial home. My dad had his own business, and so I saw the peaks and the valleys of entrepreneurship. And I guess it was kind of in my genes, but because before I knew it, we had turned in our resignations and opened up shop in our own business. We had a 300 square foot office with two desks that faced each other and a telephone, and we were in business. And we had a good run. We partnered for about 10 years. And as business partnerships go, his goals and aspirations changed. The market changed a little bit, and my interests waned to an area he wasn't all that interested in. And so we shook hands and kind of, struck out on our own after that. And one thing led to another, and I got involved in a couple of more businesses over my career. And a few years ago, stepped away from one of those businesses and had an exit. And it was, an experience different than my other, exits that I'd been involved in, which were of a smaller scale. And this last exit, involved outside capital, private equity, and boards of directors and bankers and, attorneys and as such. And I just wasn't as dialed in as I should have been. I thought I knew a lot, but sometimes you don't know what you don't know. And after I did step away from that business, I kind of reflected on it. I thought I would just kind of fade away and fade to black, as they say, and enjoy life. And when you've spent so many years in the fast lane, being in the slow lane or pulled over to the side of the road isn't all that exciting. And so I got to thinking about my last exit. And if I'd have been more knowledgeable, more insightful, had been through it at this level before, I could have done better. That was without question. And I said, I listen to podcasts all the time. And I said to myself that, there's probably a lot of other people out there in the entrepreneurial environment that have their own businesses that have scaled and grown them. And at some point in time, they're going to step back and sell and go do something else or retire or whatever the situation is. And they probably could use some insights. And that's how I got, going down this path of developing a podcast. I just decided I was going to do it. And I took a little bit different orientation instead of interviewing the actual entrepreneurs that have exited. And there's several podcasts out there that do that. I decided I would actually talk to the deal makers, the people that facilitate transactions that help entrepreneurs exit their business. And as you said, these are, M&A advisors, mergers and acquisition people, business brokers, CPAs, wealth managers, investment bankers, anyone that's involved in the kind of the transaction flow. And they just come to the podcast and talk a little bit about their stories, the good ones that worked out really well, and the bad ones that didn't go so well, and why they did or why they didn't, and a few unfortunate stories that are really heartbreaking, that an entrepreneur spent their entire career or life building up a business, and on that last lap, they dropped the baton and didn't have a great exit, and sometimes almost got nothing for their business just because they didn't plan or prepare, or of circumstances beyond their control. And most of the time, that doesn't have to happen. So, my podcast and the things that I feel real passionate about is that, entrepreneurs, people that spend decades sometimes building a business, they want to be able to monetize all that hard work and do it well. So that's kind of a little bit of my path to where I'm at today.
Yeah, I'm sure. I mean, some of those people spend their entire lives, like you said, and put their whole heart and soul into building a business, and to have it end badly has got to be heartbreaking.
Well, most of the time it doesn't have to happen. And if there's some thought is put into it, entrepreneurs are really good at doing what they do, and they do it really well because they practice it and they execute on it every day. And a good entrepreneur that has honed those skills becomes an expert at their business, their product, or their service they're offering. And sometimes this can-do attitude where they just kind of figure it out on their own because they're that type of personality that gets energized by problem solving and tackling challenges, and kind of through the sheer force of their will make things happen. And sometimes they get into the frame of mind that when it comes time to sell, they're going to do the same thing. They're just going to make things happen. The data, however, doesn't support that theory. Data will suggest that entrepreneurs that show up at the last minute unprepared for an exit generally don't optimize the value of their business. And that's just flat out facts. And if they just took a little bit of time to think about it and put some balls in motion before they arrived at the finish line, they would create substantially more value at the time of exit than if they don't.
And you've maybe mentioned a couple of them, but as you look back on your career, are there any turning points that really stand out in your mind as changes in your career's path?
Well, yeah, I think, every person that's had their business or, been reflective on the ups and downs and the winding road that they take, especially if you launched or started or bought a business, there are challenges. I can, remember wondering, and I'm sure all entrepreneurs can out there relate to how, scratching their head and, kind of painting yourself in the corner, not knowing how you're going to make payroll. And then just figuring it out. And, but the turning points in my career, I think one was early in my career, after I had mentioned that my partner and I went different ways. I had gotten involved in another business. So it involved retail locations. And I opened up a retail location, and it did it really well. And things were going well. And so I decided I was going to expand and open up other locations. And I found 3 other locations within about an 18-month period of time. And one of them was a brand new location. It was a strip center. And, I was able to get a marquee, a prime space within that center. And I spent a lot of money building it out, kind of tricking it out to make it kind of my premier type of location. And it was on a busy street. I, did all the things I thought I should be doing, counting traffic and looking at the demographics in the area. And I thought it was pretty cool. I was able to maneuver the landlord and negotiate a good lease and have him cover some of the leasehold improvements. And I was feeling pretty full of myself, quite frankly. One thing I didn't take into consideration, because I didn't come from this world. I was new to the retail space. I didn't grow up in it. I saw an opportunity and I seized it, and I didn't know what I didn't know. And one of the things that wasn't obvious to me, even though there was, 90 to 100,000 cars that drove by this location every day. These people were going someplace, generally to or from work, or not really. I wasn't really a destination, location. And I chose this location because of its visibility, because of the traffic count, because of the demographics of the area. I didn't understand, the idea of being a destination-oriented business, which the traffic really doesn't make that much difference. People came to my location because they had a problem to solve, and they would seek me out, not because they drove by and saw it. And 18 months after I opened up that location, I, locked the door for the last time and walked away because I was losing my shirt on it.
Wow.
And, that was a pivotal point in my career, because I then realized that I wasn't as smart as my press clippings kind of indicated. My other locations were going great, and they were less of a marquee location. They were second and third tier locations, and the rent was obviously lower, but they were killing it. And this location that was so high visibility, brand new location, a lot of money spent in the leasehold improvements, and I lost my shirt. And fortunately, I was able to sublease it, but walked away wounded financially. And so I approached decisions in the future much more humbly. And that was a really painful but a necessary education for me as I approached. And that business decision saved me a lot of money in the future, on how I approached other decisions down the road. So that was a turning point in my life, is that, my first business was successful. This business was headed in the right direction, and then I stumbled. And that stumbling ended up being a lesson that cost me money, but saved me a lot of grief and pain down the road, and a lot more money than I lost, that's for sure.
Yeah, wow. Like you said, you don't know what you don't know. So do you think it's necessary to fall on your face sometimes like that? Or is there some way you could have avoided that looking back?
Well, yeah, I could have avoided it if I'd have surrounded myself with the right type of people that had experience in that world. I just found this location on my own. I didn't have a real estate professional helping me out where I would outline, and that's what I did in the future, actually.
Yeah. That
outlined, what my business proposition was, the type of customers, the type of locations that I'd really needed. I got caught up in the location itself without evaluating, the type of location that I really needed. I got blinded by my ego, basically. And so what I took away from that is that if you surround yourself with the right type of advisors that have experience where you don't, generally that works out pretty well for you. And I think any entrepreneur out there that's got their own business, sometimes they think they can figure it out, but they're probably better off when, surrounding themselves or bringing in the right type of people that have been down that road before. And I never made that mistake again. I had a lot of other locations, and I never made that mistake again. I certainly had locations that were better than others, but I never had one that I belly flopped on like that one.
Yeah. So your podcast is called The Business Exit Stories. What exactly inspired you to create this podcast? Maybe you touched on it a bit, but let's
Yeah, it was just the fact. Yeah, it's just the fact that, coming back to this painful lesson, when I decided to step away from this business, I brought in outside capital, private equity. And what I didn't really appreciate when you bring in an outside investor into your company, you've basically started a time clock. And I sort of understood that, but I didn't really grasp the significance of that because, private equity is simply a fund generally that some general partners or directors of that fund attract investments from either wealthy people or institutions that you're going to go out and invest in other companies. And there's an expectation of a certain internal rate of return to that invested capital, and that there's a time window, generally 5 to 7 years, maybe 10 years for those funds. And the motivation of the promoters of that fund, the partners in that fund, is that they need to show their own investors in that fund and other future investors that they can execute at a high level. And the way that they show that is liquidation events or monetization events. And so when they make an investment in a company, they're on a timeline. They need to monetize that investment. And so they will at some point in time require you to sell, buy them out, or liquidate or sell the company. In my situation, sell the company, because that's how they realize their return. And that return becomes important to them because they will raise other funds in the future and approach other investors, and they're going to point to their past successes of how they acquired ABC company for X, and 7 years later, 5 years later, they sold it for 3X, and that generated a return in their fund. And that return, then they take the track record of that fund and they go to raise money for the next fund. And so, although I intellectually understood that, the reality of it is when things are going well and you're building your business and you got your nose to the grindstone and you can see that path to doubling or tripling your business, and you're sitting in a board meeting and the discussion turns to we need to start talking about an exit here. And and I thought, what do you mean? Things are going well. We wait another couple of years, we'll do so much better. Well, that's true, but our fund is winding down, and we need to sell by this date, and that can be very sobering, because being an entrepreneur, you're so used to controlling your own destiny and making your own decisions, and all of a sudden you have to comply with the covenants that you brought these investment dollars in. And it worked out fine, but that's one of the things I really didn't understand. So when you talk about why did I start the podcast, is, well, those type of situations, just like me, I didn't quite get it, understood it, but didn't quite get it. And I thought, these type of insights are really valuable for people like myself that had either bought or started a business and are growing it and scaling it. What are they going to need to know when it comes time to step away from their business? And who better to tell those stories than people that do this for a living every day? And they have a whole treasure trove of these deals that they've worked on, and how they unfolded, and what were the problems along the way. And I've had people that have listened to the podcast saying, "Geez, I'm so glad I watched or listened to that episode. It sounds just like me." And that his exit didn't turn out well at all. And I was headed down the same path. I'm glad that I listened because I'm going to do things differently now. And that's very gratifying to know that you've been able to, pass it forward and, you know, keep someone from making a very crucial mistake that may affect their family and may affect their retirement, decades of hard work, just from having a little bit of insight into how things can go or not go well or not so well. So it's just been exciting. I've just thoroughly enjoyed the process, and I wish I had had the podcast to listen to before I sold my business. That's for sure.
Yeah, I'm sure you've saved so many people from tears and heartbreak. And speaking of heartbreak, you mentioned having heard some heartbreaking stories. So what's one that stands out in your mind as an exit that went badly, and why do you think that it went that way?
Well, I'm going to share two stories with you. One where we had an individual that was just a real expert in his field. He had a personal services business, provided expertise and consulting, and was really at the top of his field and his game. And he got to the point where he had some health issues. And so he decided he was going to wind down his business. And since it was a personal services business, and he really didn't think he had a lot to sell, and he was just going to sell off his hard assets and walk away from it. And I got introduced to him, and we started chatting. And I realized very quickly that he had a lot of intellectual property that had a lot of value. And he was just going to kind of put it up on the shelf and walk away from it because he didn't see a lot of value in that, what he had created. And he estimated that he might have gotten $20,000 or $30,000 just on a liquidation basis, selling off of the hard assets. And we were able to position that business and approach some other people in the industry. And he got, nearly 10 times that amount out of his business because it was worth hundreds of thousands of dollars that he never saw the value to what he had. And so, people sometimes don't, because they haven't been through it before. He had never sold a business before, and he didn't know really what the process was and what was of value and what that wasn't of value. On the other side of the coin, story that an entrepreneur had built up in the manufacturing field of business. He had built over a period of nearly 30 years. A very trusty guy, as kind of a machinist type of person, that started, on the floor as a machinist and, found a specific niche and built up his business. And his business is probably worth $5 million at the time he decided he was going to step away from it. And he had an offer. He worked with an investment advisor and had an offer on the table for that $5 million range. And some of the terms he didn't like. He actually didn't like the company that was acquiring him. He didn't get along with them and had a difference of opinions on certain things prior to the negotiation process. And he had a cash deal on the table and turned it down, not because there was not anything really wrong with the deal. He just didn't like the people that were buying the business and just decided not to do the deal.
Wow.
Less than 2 years later, he went out of business, bankrupt, because that company came in and acquired another company and poured their infinite resources into competing with him. And he basically went out of business and had very little value when he tried to sell it. And there wasn't a whole lot of value there because he was leveraged. And the business did sell, but it went to, pay off debt and, creditors and things of that nature to have him exit the business. So, it's those type of stories, a bird in the hand sometimes is better than you really think it is. and it's because of his personality and because he let emotions drive his decisions instead of, following the advice of people that he had brought in to help him exit his business. He turned did not listen to their advice. And so the whole sad outcome of that, totally preventable, totally preventable. And it's just sad. It's just really sad because it had a profound impact on him emotionally and upon his family.
I'm sure.
The type of retirement he had wasn't what he envisioned.
Yeah. I mean, to go from a business that you could have sold for $5 million to nothing just a couple years later, that is a crazy story.
Yeah, and totally preventable. Totally preventable.
So I'm also sure that some of the stories you've heard are happy endings. And so what do you see as common characteristics in the deals that go well and the business exits that are successful?
Well, this is something that most entrepreneurs especially kind of bristle toward. I remember years ago, I was in a kind of a mastermind roundtable discussion, and there was a bunch of peers, people that had their own businesses, and I was kind of the younger ones at the time. And there was a guy there that had a lot of gray hair and been very successful in his business. And we got into discussing, selling businesses and valuation of businesses. And he just flat out said, if you run a good business and pay attention to building a business, the exit will take care of itself. And I always remembered that. And quite frankly, I sort of bought into it. Made sense to me. Why in the heck would you want to spend any time thinking about selling a business years or a decade before that time is coming? Just focus on the core business and the exit will take care of itself. Unfortunately, the data doesn't support that. It just doesn't, flat out. Those people that show up, and generally events drive a decision to sell. It's maybe a health issue. It may be a partner issue. It may be, you're getting burned out. There are, or the economy, or a competitor enters, or the technology changes. It's all these things that you may not control that force or get a entrepreneur thinking about selling his business. And generally, when that is the driving force into selling your business, you've already peaked, or you've already passed the point where you're going to be able to optimize the valuation of your business. Because you have a limited time. Generally, if it's event driven, you have a limited time to sell the business. 6 months, a year and a half, whatever that time frame is. And when you do that, you take away the biggest advantage of being able to strategically think about how you're going to exit, and controlling more of the events and components of an exit than showing up because you now feel that it's necessary for you to exit in a specific time frame. And generally it happens when your sales have peaked and you've plateaued in your sales growth or your profitability, and you may have even started to lose some momentum on sales and profits. And that opens up a Pandora's box for the buyer. Why are you selling? And I see that you had 2 years ago, 3 years ago, you were at, I'm just going to pick out some numbers here, $2 million in sales. And then you went to $2.5 million, and now you're at $2.2 million, and you're trending this year for $1.9 million. That's not the way to optimize the valuation of your business. If you think about it, if you were buying your business and you saw that trend, you would want to know why. And generally, you're going to hedge your bets by a lowball offer or providing terms in the agreement that protects your investment on being able to reignite growth or profitability. And so you put yourself behind the 8 ball. What you want to do is that you want to position your business where the new buyer has a lot of runway. He has some considerable upside, and you've had those year after year sales growth, and you can paint a picture then of why there's so much more growth in the future and how they can recapture their investment. And it's not a risky investment for them. It's an opportunistic investment to be able to grow the company. And it doesn't take a lot of time or planning actually to put that type of situation in motion. But if you don't do the thinking and you don't do the planning, it's unlikely. You may get lucky. There are people that get really lucky. Timing works in their favor, being in the right place at the right time. But the probability is that is a rare, an exceptional situation than a more normal, frequent one. The good exits, to answer your question, the good exits that turn out well are those that the ball has been put in motion and some thought put behind it before the time arrives. That's the bottom line.
Yeah, don't wait till your hands are tied. And as a business owner on an upward trajectory, it must be kind of hard to discern when you've reached the peak or when you're nearing the peak. How do you do that?
Well, you don't try. It's like timing the stock market. You don't try to time your exit at the peak. You want, in the ideal situation, if I were in an MBA class and lecturing on this topic and had a bunch of entrepreneurs in the class, I would say, you don't want to try to time the peak because you're probably not going to hit it. Just put yourself in the buyer's chair. Pretend you're the buyer of your own business. What would you want to see from your business to be able to, for you to optimize that value and get the buyer to, offer what you're asking or even maybe more? And if you do it right, you can get a lot more, and sometimes spectacularly more than you ever thought you could get for your business if you orchestrate the exit well and target a strategic buyer instead of a financial buyer. I have some great stories on the podcast where a buyer gets 10x return. I mean, they thought they were going to sell it for X and they got 10x. And it was because they positioned their business. They went for a strategic. They were able to get multiple people at the table for their business. Company that ended up buying them, it was strictly a strategic acquisition and primarily to keep the company from falling into the hands of the competitor. They were willing to box out the competitor and pay a lot more for the company than it was worth, so the competitor didn't get it. They certainly had a use for the products and services that the company offered, and they would get a good return, but they just certainly didn't want the competitor to buy it. And that was their main motivation, to box somebody else out. And if you can create an environment and a situation like that, you can get a lot more for your company. But just put yourself in the chair of the buyer and what would they like to see in your business. If you can position your company to show the buyer that there's a lot more opportunity in the market and that you don't believe that you have the energy, the time, or the skills to take it to the next level, and that's why you're selling, and the company you're selling to has the ability to take it to the next level. It's common sense. Why wouldn't they buy it? And why wouldn't they pay for your company what you're asking for it if the opportunity is there? But if you're at the peak and the company and the buyer sees that you've sort of maxed out the market and there's not a lot more market share to capture, the opportunity isn't there. Why would they pay up for it? And so, I just think the whole process and the thinking that goes behind exiting is something that entrepreneurs just don't take any time to think about. And if they did and started a few years in advance, then they strategically do things to position their business for an exit when the time comes. Doesn't mean that they have to exit when that time comes. It just means that they're ready. Mm-hmm. I'm actually writing a book generated really from the interest from the podcast. It's going to be called Pack Your Parachute. And it's really based on the metaphor that a pilot doesn't pack his parachute when the engines are on fire and he's losing altitude. That parachute's already packed and he's ready to go. He may never need it, But it's ready if something unexpected happens. And so if you use that metaphor to a business, if you do the right things, that you should always be somewhat prepared to sell your business because of an unexpected event that you didn't plan for. And as I said before, that may be health related. That's the most common thing, is that, you get a bad diagnosis from your doctor, and then it's all hands on deck, and you got to figure out what you're going to do with the business because you're so crucial to the business. And if you've done the right things and your parachute is packed, then you just take the parachute and you can move to the exit much quicker. And when you jump, the parachute's going to open. And instead of trying to pack it at the last minute, that's generally not the way to optimize the value of your business.
And what are your top tips for maximizing price? In other words, how do you create a strong negotiating position and maybe bring multiple buyers to the table?
It's a great question. It's a long answer, but generally speaking, the place where most entrepreneurs don't do the right things, and that is, I'll just give you three. One is the concentration of revenue, people or employees or vendors. There's some component of their business where there's an over-reliance on a specific aspect of your business that creates risk for the buyer. Whenever there's perceived risk by a buyer, they will hedge that risk, and that's generally with terms or a reduced price. A second is the entrepreneur is really the focal point of the business. Nothing happens unless he's there. You just limit the type of people that are going to be interested in your business. If the type of person that's going to buy your business is someone that is going to be there every day and making all the decisions like you're making the decision, there's a relatively small universe of people out there that fit that, bill, that profile. However, if you've replaced yourself and you have a good management team and you're not required to make every decision in the business, the universe of people that are interested as far as private equity and family offices and investment groups and management teams, there's a whole new world of buyers out there that would be interested in that type of business. So making yourself, non-essential to the business. And finally, the ability just to have the metrics of your business nailed down so that when it comes time to show the financial performance on your business, how it's doing, that you have adequate reliability in those financial reports and metrics that are kind of bulletproof, that it's all backed up with tax returns and financial statements, and they're accurate and dependable. And so someone doesn't have to second guess or try to interpret what's not there. So, and this is a discussion that could go on for the next hour or two. But those are three of the components of optimizing or maximizing value. And it really all comes back to risk. The more risk you remove from someone else stepping in and buying your business, more attractive it's going to be for someone to write you a check.
Yeah, I imagine that making yourself non-essential to the business is maybe an area that a lot of entrepreneurs struggle with.
That's because of who they are.
Yeah.
It's their personality profile. That's why they're in business. They want to control their own destiny, and it's really hard to let go.
Yeah.
And once an entrepreneur crosses that chasm and realizes that in order to scale his business and if you're thinking in terms of an exit and able to optimize the value of an exit, he has to be non-essential.
Yeah, that's great advice. So if our listeners remember just one thing from this conversation, what would you want it to be?
Have your parachute packed.
Mm-hmm.
Don't wait to the last minute. That's when the sad stories happen. That's when a lifetime and decades of hard work just do not translate into a monetization event that you were expecting. And I remember seeing a cartoon a long time ago that has a rainbow, and a guy walking down the street, and he gets to the rainbow and he looks down to the pot of gold, and it's this little cup, and it's not much gold in that cup. And he said, man, I've worked for 30 years and this is the pot of gold at the end. And sometimes that actually is what happens, but it doesn't have to. It shouldn't happen. That's the thing. You just need to. It's not that you have to spend a lot of time thinking or doing about it. It's not the work of planning an exit. It's more of a mindset. It's more of a thought process that you go through and how you make decisions in your business. Some of those decisions you make early or years before you exit can have a profound impact on the value you're going to get out of it, because the decisions created risk or contractually obligated you beyond what you thought. You weren't thinking about an exit when you made those decisions. And so 3-5 years before you get to that, you start making decisions a little differently.
So where can our listeners go to learn more and to start the process of thinking about their exit?
Well, what I've actually done, and maybe some of your listeners would like to I have certainly, listen to the podcast. I think any entrepreneur out there would find value in the stories, because every week, every podcast episode has 4 transactional stories, too good, too bad, and the takeaways. And for those out there that would like a little bit of insight on what you need to do to start thinking about it, I've created kind of a report. So you just go to businessexitstories.com/report and just download the report. And it's a quick read. It's 10, 15 pages long, and it'll just give you kind of the big picture view. And you can get the podcast at Apple Podcasts or Spotify, or wherever you get your podcast. Just subscribe to the podcast and download the report if you think it's something that might be of benefit to you.
Yeah, that sounds great. I hope some of our listeners will take advantage of those resources. Marvin, thank you so much for being my guest today.
Well, it's been delightful. I get really charged up and talking about this, because it's anyone out there that has a business should want to monetize all this hard work, the blood, sweat, and tears that goes into it. And it's not that hard if you just do the right things. It's kind of the point.
Yep. Start planning early. I've really enjoyed speaking with you and hearing about your experiences and the resulting insights. You've given us some really great advice today and probably saved some of us from some unnecessary heartache. To all of our listeners, please tune in next week. And until then, take care.
If you're ready to boost efficiency and streamline your accounting processes at significant cost savings, it's time to talk with Personiv. Their people-powered solutions have transformed the delivery of back-office tasks and general accounting functions for decades, partnering with clients to provide everything from accounts payable to payroll services. See what Personiv can do for you by visiting personiv.com.
You've been listening to CFO Weekly, presented by Personiv. Please subscribe wherever you get your podcasts to hear all of our episodes. Want to learn more? Check out personiv.com. Thanks for listening.